Chip designer ARM Holdings shares jumped nearly 25% in its first day of trading after pricing an initial public offering at $51 a share. The IPO raised almost $5 billion, making it the largest US listing in almost 2 years. Though still based in the UK, the jewel in the crown of British technology snubbed its home turf in favour of New York for its listing. But the global financial centre does not only bear the brunt of SoftBank's dispiriting decision. UK equities have lost much of their appeal after its years of underperformance. Burgeoning government debt, crumbling infrastructure, political turmoil, and consecutive rate hikes since late 2021 hurt investor sentiment. A cumulative £76 billion has fled UK equity funds since 2016, according to Morningstar said, with the bulk of outflows in the last 3 years. In contrast, global equity funds tracked by Morningstar have had £507 billion of net inflows since 2016. Brexit may take most of the blame as UK equities began slipping into record discount territory on the heels of the independence referendum. Goldman Sachs wrote that the effect on large caps has been small, but there had been a significant hit for domestic-oriented ones. What makes UK equities a tougher sell is that gilts have offered a higher yield than treasuries since 2022. As the kingdom is facing a bigger inflation problem than either the US or the Eurozone, the UK's government debt in May reached more than 100% of GDP for the first time since 1961, as inflation cost billions of pounds in extra spending. Interest rates affect whether businesses are able to meet their debt repayments and reduce their collateral for loans, which in turn weighs on banks' balance sheets. That creates headaches for the economy with an oversized financial sector. Moreover, the country has experienced the most tumultuous years in modern British politics. Rishi Sunak is trying to steady a rocky boat after his predecessor Liz Truss set a humiliating record of the shortest-serving PM, and Boris Johnson stepped down amid a series of scandals. Economists polled by Reuters expect the UK to eke out 0.3% growth this year, trailing the Eurozone, but a stark contrast to late 2022, when many forecast a recession. UK households are riding out the biggest inflation shock in 4 decades with their wages starting to outpace prices, which is reflected in consumer stocks' outperformance. Oil stocks, which accounted for a significant share of the FTSE 100, could be another tailwind to propel UK equities forward. Prices have hit new highs on supply tightening by Russian and Saudi Arabia.